Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. 3M has long been one of the most consistent companies on the market, had a long-standing dividend, generally churns out profits year after year, some of which it returns to shareholders through dividends and buybacks. And then it also traditionally has continued to grow the business organically through R&D spending. But there are a few red flags for 3M, especially as the company's growth slows. So I want to dig into exactly what's going on at 3M and why this may not be the safe investment that it's billed to be right now. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out my newsletter, Asymmetric Investing, in the show notes. I'll leave a link down there. And I want to first start with the most alarming chart for 3M. That is operating margins. You can see here that operating margins rose consistently in the early 2010s from about 20% to nearly 25%, 23, 24%. And then starting in 2016, they started to dropped consistently under 20% before the pandemic. So why is there that bounce in 2021, 2022? That's because 3M was one of the biggest beneficiaries of some of the spending throughout the pandemic. So masks, a lot of those masks came from 3M. Hospital equipment. People were working from home, so they're buying office supplies. There was a lot of spending that went on that actually benefited 3M, at least short term. But you can see over the last year that margins have just collapsed. Now, there are a number of reasons for that. This is a diversified company. But the long-term trend I want you to look at is from 2017 through today. Without that little blip during the pandemic, you can see that operating margins would be consistently lower year after year. Clearly, 3M is not generating as much margin, as much pricing power as it historically has as a company. And that's very concerning. That's red flag number one. The second red flag is the fact that 3M's R&D is simply not paying off like it has in the past. Throughout most of the 20th century, 3M was known as an innovative company. So they would pour money into R&D and then products would come out like Scotchgard, Post-it notes, brightness enhancement films. These are the iconic products that make 3M who it is today. Can you think of a name brand iconic product that 3M has introduced in the last 25 years? I think you're going to have a hard time thinking of that. And that's despite the fact the company has spent billions of dollars on R&D. Now, one of the things that is strange about R&D spending is that a lot of R&D spending is actually maintenance on keeping existing products going. So chemicals need to be updated. Packaging needs to be updated. Some of these expenses end up in R&D. And we've seen that since 2000, R&D spending has come down, and even the spending that is happening is simply not paying off. Revenue over the past decade is up just 8.9%. Now, 3M has sold a couple of businesses, but even still, revenue growth is nowhere near where you would expect for an innovative company that's growing. And that's one of the challenges that 3M faces. The innovation engine is simply not there. And the final thing comes down to the company's financial metrics. You can see here that over the last 20 years, 3M's payout ratio, or the percentage of earnings that it pays out in the form of a dividend, has been increasing steadily over time. So that dividend steadily grows, but to grow the dividend long term, you need to actually grow earnings and grow cash flow. 3M has clearly not done that. As a result, they're paying out in dividends a bigger and bigger percentage of earnings. That's actually a red flag for companies because it means that they're not pouring money back into the business. They're not growing the business organically. They're just paying out what they make to shareholders. The fact that the payout ratio has spiked above 75% is really concerning. And if earnings continue to decline and management keeps the payout where it is today, the only alternative is to actually take on debt to pay out the dividend. That is not something that ends well for companies. So when you look at 3M today, this is not the robust growth innovation company that we thought of it in the 80s, 90s, early 2000s even. A lot of the efficiency that's come into the business since Jim McNerney took over in the early 2000s has meant that 3M has given up on a lot of its growth objectives. So margins went up over that period of time, but eventually you have to pay the piper. And recently we have seen margins start to decline. The payout ratio is going up, and R&D is simply not paying off in the way that it did for a very long time for 3M. These are major red flags for the company, and one of the reasons that I'm simply staying out of the stock. I think investors looking at 3M as a value right now are thinking about a company that doesn't exist anymore, and that's just the reality on the ground. But what do you think about 3M Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.